Good morning, welcome to the ADS Securities Markets Update. Starting with a big event yesterday, the Federal Reserve has once again played with the statement of phrases. Indeed, they removed the patient from the statement. However, Janet Yellen in her press conference noted that the removal of the patient does not indicate that the FOMC will be impatient. In conclusion, the Federal Reserve will be patient. The Fed also noted that the rate hike in April's meeting is unlikely. And Janet Yellen also noted that she cannot rule out a rate hike in June's meeting, and the next decision will be data dependent. The Federal Reserve also downgraded its growth and inflation estimates again and improved the unemployment or the labor market outlook. And the Fed fund futures now are pricing 0.5% Fed fund rate in February of next year instead of September of this year. If the upcoming decisions are data dependent, then we should not estimate any rate hike anytime soon until at least September of this year, if not later. The US dollar was hit across the board yesterday, and the dollar index fell to as low or below even 98 until this report is released, signaling another short-term decline on the downside in the next few days. Crude oil spiked also side by side with the US equities in addition to gold, and crude oil, basically, or the West Texas crude spiked to above $45, and gold even trading well above $11.70, while the S&P and Dow Jones indices also added more than 1.5% for each index. As noted in our previous reports, the Federal Reserve replaced patience with uncertainty, even though that Janet Yellen could not rule out any rate hike timings for the time being. We believe that the Federal Reserve will continue to do the same over the next coming meetings before retreating again from raising rates this year as the economic developments continue to slow down further. In the meantime, traders need to be very cautious, as from now on, the economic releases are likely to have a notable impact on the markets. As for the dollar index, a weekly close right now is the key, as a weekly close well below 97.76, which is last week open, which would be, or it would be, a new signal for a short-term decline on the downside. As for the Asian session today, there were only two economic releases from New Zealand and Japan, which had only a slight impact. But in New Zealand, the Q4 GDP came in as expected, growing by 0.8% in Q4, while Q3 GDP has been revised lower slightly towards 0.9 instead of 1%. In Japan, all industries activity index also increased by 1.9% in January, comparing to a decline of minus 0.1% as widely expected. As for the European session today, there are a few economic releases with key events which are likely to have another major impact on the market. In Switzerland, the trade balance surplus is likely to decline again toward 2.87 billion in February, comparing to 3.43 billion in January of this year, which would be also the lowest surplus in almost 2 months. The Swiss National Bank is expected to announce its monetary policy assessment today, and the bank is likely to or expected to keep the current policy unchanged, given the fact for the continuous decline in Swiss franc, and also the euro Swiss is well above 1.06 so far. In the Eurozone, we will be watching the EU Economic Summit today, discussing the global economic issues, including Greece. And the tensions are rising again for a Greek exit again, as Greece angers the creditors with lack of information lately. And therefore, traders need to follow any official remarks, and we will of course bring it to you through our social media sites and our research emails. As for the ECB, also the ECB is expected to announce its targeted LTRO funds today. The estimates are to allot around 40 billion euros today, compared to 129.8 billion euros in December of last year, which would be also the lowest since the beginning of the targeted LTRO program. Going forward to the US session today, there are three economic releases across the session which are likely to have another major impact on the market, especially if they disappoint again. First of all, the jobless claims is expected to rise again toward 295,000 last week, up from 289,000 the week before. The current account deficit is likely also to widen further toward minus $103 billion in Q4, compared to minus 100 billion in Q3 of last year. And if the numbers came in as expected or come in as expected, this would be also the biggest deficit since Q2 of 2013. Finally, the Philadelphia Fed Manufacturing Index is expected to rise again towards 7.2 in March, compared to 5.2 in February. And this disappointment also today, or any disappointment today, would lead to another round of US dollar sell-off. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. You can like this video if you like it, and you can also subscribe it and share it with your friends. Thank you for watching. I'll see you once again tomorrow.